Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, of course, is Michael Becker.
Hey, Paul.
And also James Zhang. Hey, James.
Hey, Paul. How's it going?
I'm doing well. So in the podcast today, when you think of real estate, you think of CBRE in the commercial space. CBRE is joining us in the podcast today. We are fortunate to have Chris Deuillett from CBRE and Danny Baker from CBRE. And they're going to talk a little bit about what's going on in the Dallas market, what's going on in the Texas market, what's going on in the national markets, and a little bit about getting to know them, get to know who the brokers are for CBRE. So we're going to have a little bit of an intimate conversation with the guys from CBRE. And so, James, I'm going to kind of kick it over to you. First, anything about asking for a rating?
Sure. If you guys like what you're hearing so far, please give us a rating on iTunes. 5 stars is preferable. Any comments on there as well. And if you have not RSVP'd to our event coming up in April, it's Wednesday, April 26th. We're going to have Mark Dotzauer from the Texas A&M Real Estate Center, former economist there, speaking at the Grapevine Convention Center at 6 o'clock. So please RSVP to that event if you haven't.
You definitely want to go listen to Dr. Dotzauer. He is a champ and really explains things very basically about what's going on in real estate, not only in the state of Texas, but also in the nation. Mike, let's kick it off.
Yeah. So, hey, Chris, Danny, thanks for coming in today. Appreciate it.
Thanks, Mike.
Thanks for having us.
Yeah. Maybe we'll kind of start. Chris, why don't you kick it off and give us a little bit about the background on yourself and you too, Danny, and tell us a little bit about kind of who you are and who is CBRE.
So I've been doing this, selling multifamily properties for 17 years. I grew up in North Dallas, and this is really like driving my neighborhood, really focusing more on the older, let's call it mature properties in the Dallas-Fort Worth area.
Vintage.
Yes, very much so. But very much enjoying it. Grew up around real estate with my family, and so this is really old hat for me.
Yeah. Danny?
Grew up in Milwaukee, Wisconsin. Sometimes people accuse me of having an accent, which I suppose I'm guilty of. Paul as well, a little bit, being from Chicago. I ended up in real estate somewhat by happenstance, but have been doing it for about 7 years at this point. I thought I was going to go get my PhD in economics and work for the Fed, was kind of the original plan, but ended up getting a job at CB in the consulting group. Quickly switched over to the transaction side and been doing that since about 2010.
Well, good. Well, tell us maybe a little bit about CBRE. Most people probably know it, but for those that don't, maybe kind of what's the platform like, and then what's your office like here in North Texas?
Sure. We're a Fortune 500 real estate company. We have all business lines. We do industrial, leasing, office, retail, leasing, tenant rep, debt and equity finance, consulting. We have an economist group out of Boston called CBRE Econometric Advisors. And we have about 55,000 employees worldwide. So really kind of cover the spectrum. Here in North Texas, we have about 7 brokers working on the multifamily side, covering anything from 1960 to brand new construction. Each one of us has a little bit different specialization, but generally kind of covering North Texas as a whole.
And then you and Chris focus primarily on Class C, Class B, maybe A-. Is that kind of generally what you guys focus on?
Yeah, pretty much, 90s and older type of stuff.
Good.
So what we'd call B and C product.
What kind of volume do you guys do out of DFW, for example, in say 2016? Do you guys have I'm putting you on the spot here. Do you have your stats on how much volume you guys did in 2016 in the multifamily group in North Texas or DFW?
Yeah, we did about $1.5 billion worth of total capitalization in 2016, which is on par with 2015 generally. There's a little bit more volume in 16 than 15, but yeah, it's about $1.5 billion to 2, depending on if you include the student side or not. It'll be closer to 2, and just conventional multifamily about 1.5.
So good. Well, then maybe we just kind of what I want to kind of at least spend the first half of the podcast on is kind of just state of the market and what's going on and what you guys are seeing out in the marketplace. We record this towards the end of February 2017, so we're about 2 months into the new year. So what's going on in the marketplace? What are you guys seeing?
We're seeing, I'd say, a lot of interest. I think as a general one-line statement is we're seeing a lot more capital than I'd say 12 months ago, but we're seeing them chase fewer deals. So the lack of product on the market is definitely a driving factor, but the amount of interest that we have on each one of our deals, I would say, is increased.
Versus this time, say last year?
Let's say, from 12
Really?
months ago.
So it's in your observation, there's less inventory today than 12 months ago?
As a rule of
whole?
thumb,
Yeah.
yes. Yeah.
Is that across all asset classes, or all asset like A, B, and C? Is it the same, or do you see any differences? Is there more like of one certain type of product on the market versus the other? Is there more A on the market versus a B or C?
We have a couple new construction properties out in the market right now, but there isn't generally a lot of product, anything 60s, 70s, 80s, 90s. There's not much of note out in the market right now. So, there's definitely a supply-demand imbalance, and as Chris alluded to, coming out of NMHC, we heard a lot of talk of an immense amount of capital wanting to invest in Texas, and certainly seeing that with number of registrations for confidentiality agreements, number of OMs downloaded, number of tours, but really a lack of product in the market. So an increased level of interest, I would say.
No. What's your guys' take generally on the health of the Texas, and maybe more specifically the DFW multifamily market? What are you guys seeing out there from like an operations standpoint? Is it soft? Is it stronger? And how's that kind of compare over the last several years?
I would still say it's very strong. I mean, if you own product right now, Dallas-Fort Worth is probably one of the top markets. And you can look at all the statistics nationwide. Operations for apartment ownership is very strong. So occupancy is very tight right now. Rent growth was very strong in 2016. It'll probably level off a little bit, but we're still seeing well above average historically rent growth for 2017.
And I would say, to add to that point, specifically in the kind of B market, $700-800 type rents, there is an incredible amount of demand for that product right now. There's a lack of it, and they're not building it right now. So for true workforce type housing, we're seeing record high occupancies and rent growth as a result of that, certainly.
Can you talk to two sort of bigger risk? I mean, especially on the sort of B plus, A minus stuff. A lot of people obviously in Texas are concerned about supply, especially here in Dallas. And, some of the new construction stuff coming out of the ground and just going through lease up. What are you guys seeing on the lease up side on these new deals?
Sure. I think that's really sub-market focused. We're selling a property right now that's 1997 built JPI product, 434 units. It's south of here, about 3 miles. Down the street from that property is a brand new wrap type construction property.
That would be in Plano, Texas?
That would be in Plano, Texas.
North Dallas. Yeah. All right.
So the rent roll at our property is at $1.19 a square foot. The new lease-up deal is at $1.65. I bet that probably grows after the first-generation leases start turning. So I would say the new construction is certainly something to watch, but not as much of a risk factor for kind of 80s and 90s product that's a material discount to a renter, because that's not a renter that wants to jump up and pay $300-400 more a month in rent.
And so you're seeing in North Plano, which is a top flight suburban submarket here, a lot of employment. There's probably about a 25-30% delta between the brand new Class A and kind of like an A minus product in general for pricing and rents.
Yeah, I would say that's probably about right. And even fully stabilized, there will be less of a gap, obviously, once all the units are renovated by the new buyer, but still a material discount, which is going to be attractive for the buyer and also for the renter.
And then on the other side, I mean, on the B and C side, what are you guys seeing in terms, rents have grown 30, 40, 50%, maybe even in some submarkets on the B and C side. Are you seeing any pushback on rents, especially for new buyers coming in and still trying to get, 5 to 10% rent growth year over year?
Well, to segue a little bit into what Danny said on the older product, you're seeing if somebody comes in and rehabs a unit, does it right, you're seeing a much greater delta than I'd say a year or two ago. And that's because we're not building, older vintage C product, new product. We're building the A product. So there's a little bit of a compression down on the older product. So if somebody comes in there and rehabs the kitchens and puts in backsplashes and really modernizes the interior of the unit, even though it's built in the early 70s, the delta, the change from, let's call it a classic unit to an upgraded unit, is a lot more significant than it was probably this time last year.
So, I mean, a big change year over year probably not only is supply and demand, but then also interest rates. I mean, how have you addressed that with sellers on deals and buyers coming in maybe lighter on their debt quotes than they thought they were 5-6 months ago?
Yeah, as the market is strong enough just to kind of wash that over so far. I know we're only 3 months into it or so now, so we haven't had a ton of history, but to James's point, rates are up, so it's compressing yields for the buyers when they're underwriting. Has it just been washed over, or has that had an impact on pricing?
So right when the run-up started happening early November, there were about 63 assets under contract between Charlotte, Atlanta, Dallas, Fort Worth, Phoenix, Seattle, and Boston. The average retrade was 1.8 to 3% of the deals that got retraded. We're of the mindset that generally pricing is up 25 basis points on a cap rate, which should translate to about a 5 to 6% decline in value. However, I will caveat that with we have not bid any properties yet this year. The first round of call for offers is coming up in the next week. And with the amount of interest that we've seen, I would say there's probably enough capital to kind of keep somewhat of a downward pressure on cap rates. But like I said, we'll find out in the next 2-3 weeks exactly how that's going to play out.
Gotcha. But you guys were anticipating about a 25 basis point increase in the cap rates?
Generally, yes.
Yeah, so after the election and they saw the spike in the 10-year Treasury, we kind of adjusted 25 bips on the underwriting.
I mean, let's maybe start on the seller side on some of these deals and talk to some of the guys who already own properties out there. How are you seeing sellers position their property well so that when you guys come in, you're able to list the property, get strong tours, strong offers on these deals? Any 1 or 2 tips out there for sellers that are wanting to list deals in the next, let's say, 3 to 6 months?
I would say, in a nutshell, the better the story on the deal, the better the interest will be from buyers. So let's say if it's a property that you rehab 20% of the units, let's say, and you've proven up, hey, the rent is going to be X, then the next buyer can be easily convinced that's what's going to happen for the next 80% of the units. So if you can show that and shore that up and show that numbers don't lie, you put this out in front of a buyer, they're going to take a hard look at the deal.
And actually, you guys were talking about something when I came in earlier about a transaction, not knowing exactly what units were renovated. One thing that's really easy to do is have your property staff walk all the units and denote on the rent roll what's upgraded, what isn't upgraded. So when we do our financial analysis of the asset, we can pull out and, to Chris's point, prove up the story of, yes, the premium upgraded units are getting $100 to $150 or whatever the case may be. And then we can apply that metric to the unrenovated units and kind of roll that in and maximize value for the owner, I should say.
I guess on the flip side of that, anything that you've seen sellers do that maybe weren't favorable and impacted their ability to sell the asset in the last year? Is there anything that you guys can think of?
Don't change management companies a month before you put the property on the
That's
market
strange.
with the new chart of accounts. That,
Or if you're under contract, don't
that
change
tends
management
to
companies.
make things a little bit more difficult.
Did it happen, I guess?
It may have happened once or twice, specifically one that I'm thinking of. But yeah, definitely don't change management companies. If that's something that you're thinking of doing, that's obviously your right as the owner. But if you're contemplating a sale, talk to the brokerage community, the brokers that you're specifically working with on how best to handle that, because it does make it very difficult for investors to properly underwrite the cash flow of the property and value it accurately.
Well, and that would, a little more broader swing at it would be, don't make any drastic changes and mean like, hey, let's redo the parking lot or something like that, or where you got to increase a maintenance crew. And so all of a sudden when you're looking at payroll or maintenance and repairs, that number is really out of whack right before you're going to put the property on the market, because everybody's going to ask that question.
So you're really trying to smooth out the T12 maybe on the expenses, get a strong T3 on the revenue, and just keep collections at a stable number.
Keep the property full and have a positive lease trade out. So you're seeing positive rent growth, but don't try to raise rents $300 because it's probably not going to work unless you're doing some large scale renovation, at which point you should probably complete that before selling the property. But just having a stable level of cash flow for investors to underwrite off of is the best way to be successful in that.
Okay, great. And then, I mean, on the flip side of the listing side and the sellers, talk about buyers. I mean, how are guys standing out in a market where you have a call for offers, there might be 20 people, and then you have a best and final, 3 or 4 more people, and then choosing that final buyer? What advice would you have for guys who are going through that process right now?
Simply put, I would have all your ducks lined up in a row. So if you've talking to a lender, you've got your financial statements ready to show, because Danny and I speak to quote unquote buyers from anywhere in the nation on a daily basis, multiple times. And we don't know them. We've never met them. They've never visited. And they're asking us, hey, Chris, give me your good deal. Off market, on market, give me your good deal. The chance of me doing that with a person that's unproven is slim to none. So, but if somebody comes in there and submits a letter of intent and has toured the asset, or at least really looked at it, crunched the numbers, and then backs it up saying, okay, here's what, my real estate resume is X, and then here's where my equity is going to come from, and here's a loan quote that's looked at the deal, then you've got a pretty good story to say, hey, I like the deal, and I can go the distance and close on time.
And I would add to that, all great points. I would add having the capital expenditure budget nailed down as best as you possibly can. It's usually good to have the construction manager tour the property with the principals and get a really good picture as, all right, do we need new roofs? Do we need a new parking lot? What are we going to budget for unit renovations? And having that actual dollar amount itemized is really helpful and kind of proves that you've done your homework on the asset.
Once you do best and final, you have interviews with the different buyers. How much detail should buyers be giving about that type of stuff in the interview? And give us some tips on that interview and what you like to see from buyers and what's helped guys win deals at that point.
Sure. We have a questionnaire that we send out to investors that'll detail how you're underwriting property taxes, how you're underwriting replacement reserves, what you're underwriting from a debt standpoint, and what you're underwriting from a capital standpoint for what is actually going to be put into the property. So it gets pretty detailed. And most groups that are winning transactions are as transparent as they possibly can be about those items to get a level of comfortability with the seller.
Have you seen anything lately that kind of stood out in your mind that are like, oh crap, don't do that again, or that was a horrible move? The example I like to give, we were on a best and final call on one property we're selling, and we asked the potential buyer what his capital budget was. He told me, none of my business. He literally said that on the call. So, something like that, right? Is there anything that people just are common things, even if they're not as egregious as that they shoot themselves in the foot as a potential buyer in the deal, besides just being organized and having your team and ducks in a row?
A little on a broader scope, those phone interviews when we're at the best and final, we've seen it go both ways. Sometimes the buyer really steps up and he's impressive and he delivers on the phone and everybody's convinced, okay, this guy's the guy. And it surprises us. Then there's others where we do phone interviews and go, this guy, he's polished, he knows what he's doing. He gets on the phone and he just says things that's like, boy, this guy hasn't really vetted the deal, or his potential of doing this deal all the way through is slim. And so sometimes they shoot themselves in the foot on the phone, and sometimes they deliver unexpectedly. So
in general, have a good attitude, be well organized, and be enthusiastic about the deal. Nitpicking every little thing about the deal is not a good way of endearing you with a potential seller or the listing agent, correct?
Correct.
Yeah, definitely cool.
And one other thing I just chime in there, that's also the buyer's opportunity to ask questions to the seller. Don't think it's just a one-sided interview kind of thing. It's like, well, Mr. Seller, we've got a couple of questions on the physical assets. What have you done? Or give me some background on the property and this kind of, it's a time to also find out some potential pitfalls and catch them early.
Yeah. So, and don't ask the seller to seller finance it on the interview call.
Yeah.
Maybe have that one kind of lined up prior to. So
yeah. Pro tip there, right?
Yeah. Talk to Old Capital before.
There you go. So back to kind of deals that are on the market. Why are people out there selling today? Like, what's the motivations of the sellers in the marketplace today? Obviously, it seems like the last 5-6 years we had one heck of a run here. So I know cap rates are compressed, but what other motivations? Is it debt coming due? Is it equity issues? Why are the last several deals you guys selling? Why were the sellers selling?
We've certainly see this year specifically kind of a spike in maturities, which is going to drive a lot of transaction activity. Another reason is investors who bought properties 2 or 3 years ago are through their business plan a lot quicker than they expected. They're getting the rents in year 4 or 5 in year 2 or 3 instead of year 5. So they execute the business plan and decide to exit the property, if not early, maybe right at the exact time when they were originally underwrote. But generally, property level performance and how well tenants are taking to the upgrades and how quickly they're able to get to the premiums is much quicker than a lot of the investors who were buying properties a couple years ago expect.
Can you guys talk about, Chris and I are working on a deal right now where it's an assumption of a Fannie Mae loan and we're trying to put a supplemental on it, on top of it right now. Can you talk about the difference between bringing a deal free and clear versus maybe it having existing debt and having to assume that debt? And what are you guys seeing in terms of the amount of bids on one type versus the other, and then also pricing?
My initial thought would be free and clear is the choice of it. Obviously, there are some parameters where you can't do that, but there are lenders out there besides just the agencies, but local banks, things like that you can really structure financing a certain way, whether it be certain loan to value, interest only for 1 or 3 years, loan to cost where you build in your rehab dollars, that kind of thing. And so there's just a lot of options out there from a bank. So if you can go all cash and let the buyer decide on how he wants to structure this going forward for the years 1 through 5, that's ideal. A lot of the times right now, if it's an assumption, that really does impact the value of the property. You got to back into a certain loan to value or whatever, and that sometimes is restrictive on an assumption.
And then how much research are you guys doing just on the buying groups? Anything that these buying groups can do in that case, right, in terms of assumption, proving up their experience and all that type of stuff? Do you get them on the phone with that specific lender early, or any tips for them coming in on an assumption like that?
Google's our friend. So, if we don't know anybody, we just go to Google and, who knows what comes up on somebody. But I mean, we try and vet them as best we can. But, that being said, it's still very hard to find out how a person's actually going to perform.
And we'll ask for references specifically with the servicer of the mortgage that's being assumed, and try to go down that path to find if they have specific experience with Fannie Mae or XYZ servicer to make sure that what they're telling us is not only the truth, but they've been able to successfully execute a loan assumption.
And James, would you recommend for them to call, say, you at Old Capital with the help of an assumption? Why is it better for somebody that is having to assume a loan go, say, through a third party instead of going through directly to the lender? Why is that?
On a lot of these transactions on an assumption, they're going to be comparing the existing buying group with your new borrower. So a lot of these deals, we either place the financing on originally, so we know the current seller very well, or we can talk with the existing lender to figure out, net worth, liquidity, experience of the current seller, and really tee up your buying group appropriately in terms of structuring key principles and your management team, and who's going to be on the existing buying team, so that we can come in and, get the deal approved and not only get the loan assumed, but then also add a supplemental if the property qualifies.
So you guys sell a ton of deals, right? So you sold about $1.5 billion or $2 billion, depending on if you have the student housing in North Texas last year. A lot of that is in the B and C space. So what have you guys seen? You see different operators and how they do stuff. Some examples of some guys that go out there and do it well. What are the things that they do that are most effective when they're selling it, like with the amenities or just how they implement the value add? Has there been any kind of new things you guys are seeing out there from an amenity set, or any new tips on renovations that you've seen that have been extremely well received in the marketplace?
And me focusing more on just the C product. So when I refer to a deal, I'm talking about a property that's built in the 60s and 70s, let's say, or early 80s. I would say a couple of years ago, the big thing was an accent wall. That seemed to, you'd give a potential resident 3 paint cans. You pick the color, we'll slap it up on the wall. And they would get another $20 or $30 for that. And now it's for sure a full backsplash in the kitchen. That is, I've asked multiple managers, over in Dallas and Fort Worth, hey, if the backsplash wasn't there, if we added the backsplash, how much more could you get just for that backsplash? And the variance is $30 to $35 just for that backsplash. Backsplashes, they don't get torn up. They stay there. It modernizes the kitchen. And just like if you're going to sell a single family home, if you've got an upgraded kitchen, you're going to get more bang for your buck than what you put into the deal. And that's the same thing with a unit. Even in a C product, the kitchen is where most people are getting the most bang for their buck on a rehab.
Anything like on those 80 deals, you have all those old concrete tennis courts that are beat up and look like crap. Or, I know
sports courts.
Yeah, sports courts, things like that. Have you seen anything unique or different on a tennis court, or any of the mini set that on an 80s deal that you hadn't seen maybe 2-3 years ago? Is there anything new, or in the office or anything like that you hadn't noticed 2-3 years ago that people are doing now that's effective?
If you look at every OM generated by every brokerage shop in North Texas in the last 3 years, you're going to see dog park.
Sure.
So that's certainly a good one. People love their pets and spend money on their pets. What I find interesting is when they get rid of the business center but add wireless internet throughout the clubhouse onto the pool deck area, because most residents aren't using the old business centers anyways. They're wanting to use it specifically for the wireless. They don't need the old 1997 PC hanging out in there. They just have their laptop or iPad or whatever it happens to be. So that seems to be something that's pretty well received by residents, certainly.
Gotcha. Have you guys seen any interesting stories here lately, or any sort of funny stories when you guys are out there walking deals? You've seen sort of crazy stuff. I was sharing with you before, like the property we owned, we had a unit that had an aquarium with 2 live ducks in it when we were walking it once. Have you guys seen anything interesting over the last few years?
I was walking some units with a client of ours that owns some properties in DFW, quite a few, and walked into a unit and there was a Glock on the kitchen floor. So I decided at that point to probably exit the unit before they woke up and decided that they wanted to use it on me. And also there's another property we're doing in mid-cities area that always had truck drivers parked out front. I can never quite figure out why that was happening. And I guess there was a working person living in one of the units, if you know what I mean.
They weren't charging on a monthly basis. They were charging on an hourly basis.
Or half hourly, depending on who you are, I suppose.
One of the oldest jobs in the world, right?
So, a lot of people don't know who you guys are to meet with you. And a lot of people want to buy apartment buildings. What gets your attention for somebody that has never bought a property before but wants to get on your list? I mean, and this is really a question for Chris. I mean, how do they get to know you, Chris?
So a couple of things that I think have stood out. If somebody's entering the market, let's say, and you're starting out and you're wanting to own in DFW, pick up the phone and call. Just a flat out email, let me introduce myself. It doesn't go very far at all. Even just hearing the voice, you kind of get who the person is, their personality, that kind of style. And then also, it'd be very important for them to get on the plane and come down. And even if they're not have a deal under contract, but come down to Dallas-Fort Worth and look at a couple of deals that are on the market, drive the area, spend some time. If you're going to own a multi-million-dollar deal, it'd be important for you to spend, a couple $100, get on a plane and fly down here. And then at the same point, visit with us in person, visit with the community, the industry, and get your arms around it before really jumping in and buying a deal.
And then on that note, how many people are actually buying properties from you that are Texans, and how many are from outside the state of Texas?
I would say it's probably 50-50. Before the recession, I guess the last downturn, it was a lot of West Coast money, but now we're seeing international. I mean, you name it, Israel, Asian, Mexico, Canada. I mean, it's really coming around a lot, just partially because it's the United States, but then just the whole story that Dallas-Fort Worth has, the movement with Toyota and State Farm.
And that's the next phase of the question. Danny, I mean, your guys, 90% from other places instead of Texas, institutional guys out of New York. I mean, who are your buyers on your deals?
I would say not 90, but probably 75 to 85 generally. Yeah, it's a lot of either institutional money coming direct, or it's groups that are forming a JV with an institutional partner that may be based in Dallas-Fort Worth. There's a number of large groups that are doing that formula right now pretty successfully. Mm-hmm. But I would say 75 to 85% outside of the state of Texas, and the money behind them it's any guess where it's coming from. And one partner of ours has a JV partner out of Australia, Singapore, government of Singapore, in fact, Japan, China, mainland Europe, Germany, Sweden, UK, all over the place.
So it's really from all over the United States, are people trying to seek the opportunity to really get higher yields with higher leverage in Texas.
Correct.
Well, speaking of that, so versus their normal syndicated group, like a guy like me, for example, that goes out and raises private money, goes and buys a deal. You have any observations on how groups like mine versus more institutional groups look at these deals differently, or are there certain parameters that an institutional group has to have or won't do that a syndicating group would either take a little bit more risk on, or what are some of the nuances and differences between those two types of groups?
I would say on the institutional side, a lot of those groups are not necessarily solving back for a cash-on-cash return and just looking at year by year. A lot of them are looking at an IRR, levered and unlevered, and a lot of them have leverage constraints. They're not typically utilizing 75 to 85% or 75 to 80% leverage. There may be a covenant with a specific partner or with the fund that they're representing that's going to 60-65% leverage constraint that they're not able to go past. So more of an IRR, a little bit longer hold period, generally speaking, than the private groups. Chris, would you agree with that?
Yeah, I would agree with you. And more on the private groups, I think the consideration for the partnership or the partners that are behind the key principal, that's very important. So if they're expecting an 8% cash preferred return, that comes into play. So there'll be certain syndications that look at a deal and they look at them very differently, and their offer comes in very differently, or they pass on the deal even though it's what they own, it's in their portfolio, but it's just for some reason doesn't fit their partnership's preferred returns. And
I would add to that as well. There's generally a minimum check size for institutional investors. I was with one yesterday, and he said if he can't get $20 million out the door, then he can't even look at the deal and take it to investment committee. So the good thing about that is that it takes them out of the smaller property range from 2 to 15, 20 million range. They're generally playing with properties in the $50 to $100 million and plus portfolio type transactions.
And then you guys have a big portfolio out right now. I know you sold a couple last year as well. How's the portfolio process different? Because a lot of guys listening to this wouldn't be able to go look at a 2,000 unit portfolio, something like that. How does that process different when you go out and market a portfolio versus, say, the one-off transaction?
Sure. The background work is much more intensive. If it's an owner that has a lot of units across the country, we'll get in early with them. They'll send us the list of all the properties, NOI. We'll underwrite each one of the properties, and then come up with a strategy for them on which would be the best grouping. And what we've found has been that the homogeneous property types and similar locations, whether it's a Arlington, Texas with a similar Arlington type location in Atlanta, that's okay. Sunbelt is generally viewed similarly. And then when we take it to the market, it's a little bit different because there's a lot of properties at once. So you have to know a lot more at a specific point in time. And it's just it's a different process that's a lot more resource intensive, I would say. You get into the allocation game where you have investors that are underwriting each property differently, but the end result is the exact same number. So you have to get back with your seller and talk about, all right, is there a different partnership with each one of these? And then ironing out that side of it can somewhat be difficult. But it's just a lot more resource intensive game and strategy intensive game when you're talking about aggregating 5, 10, 15 properties at a time and much larger dollar amount.
Are sellers getting a premium for bringing a portfolio? Let's say in Dallas, instead of bringing one property, they're bringing 3 in a sub-market. Are they getting 25, 50 basis points lower in cap rate because someone can write a bigger check, and so maybe appealing to a larger capital stack?
It's a different pool of investors looking at those type of opportunities, more quote-unquote household names. The most recent portfolio that we did was 7 properties, and the premium was about a 4.5% over the individual offers that we received. I've worked on...
The aggregate was 4.5% higher than the one-off offers? So.
That's correct. We've worked on 19 portfolios since 2010, 44,000 units, about $4 billion in capitalization, and very rarely do we find that they break up into individual transactions. Almost 99 times out of 100, it's going to be more beneficial because the transaction's cleaner and easier on a portfolio level, and pricing is usually more accretive than individual.
So who takes down a 2,000 unit portfolio? Like just large institutional type owners, or like who are bidding on those large portfolios?
If I generally would say if it's between 75 million and 200 million, it'll be a private group with an institutional partner behind them. If it's $200, $300, $400, $500 million up to $1 billion, it's going to be an institutional investor direct. So it just kind of depends on how large the portfolio is and what the composition of the assets are. If it's a core portfolio with brand new high-rise product, that's going to absolutely either be foreign money or institutional out of New York or LA or Chicago or wherever. And more regional, kind of 80s or early 90s type portfolios will be a local group or a regional group with an institutional partner behind them.
So what can we learn from those guys? Because most of our stuff is, 5, 10, 15 million, $20 million. What can we learn, take a zero off of those deals, and what can we learn and bring to deals that you've seen?
That's a good question. You talk to these groups and they are just capital raising machines. I mean, it is absolutely incredible. So typically what they'll do is they'll have they're vertically integrated. So they'll have a property management company and they'll have it fully underwritten. They'll have the rent roll spread, and then they'll go shop that to various equity sources. But the one thing that's kind of consistent is that they, as Chris said before, they have their quote-unquote ducks in a row. When they come and they bid a property, they've been on site probably 3 times. They have the CapEx budget nailed down to a T, and they have a lender that they've done 25 transactions with ready to go, giving them soft quotes. And the timeline is usually pretty quick. The last one that we did was a 45-day close all in. They used floating financing, LIBOR-based, and they just absolutely had it dialed in before we even got to the offer date. They were ready to go. So being incredibly organized and utilizing the vast resources that they have.
So besides, 45-day close, any other terms in these LOIs or purchase contracts in the last, let's say, 3 months that are winning deals? Like what due diligence time frame, earnest money, that type of stuff? Yeah,
we've seen, and I'll let Chris take that one as well, but what we've seen more recently for groups that are really competitive is non-refundable earnest money. That's with the obvious caveat of existing title and environmental. Basically, anything that would prohibit the seller from conveying clear title to the owner. If that checks that box, then the money is non-refundable at the execution of the contract, and quick DD timeframes as well.
Yeah, that's what I was going to say. Traditionally it would be a 30-day look or inspection period. Now I would say that's really tightened up. 14 to 21 days really seems to be the norm nowadays on one-off deals.
We all like Texas. We especially like Dallas. Chris, between you and I, what areas of Dallas do you like? What submarkets do you like and why?
There's the ones that everybody kind of talks about, but the one that I think is really kind of off the radar screen like the dark horse would be just west of the new Margaret Hunt Hill Bridge. So that'd be West Dallas. There's some new development going on there. Roger Staubach's involved. But that doesn't seem to get a lot of attention like some of the outer suburbs, McKinney, Frisco, Allen, that kind of thing.
Are there older supply there, or is this just all brand new?
It is older supply, but you're seeing a lot. Retail is coming in there, barbecue joints, that kind of stuff. It's just it's getting a
older supply of size, or is everything kind of your one-off 12-unit old 1950 build deal?
Yeah, so you got a wide range. So there is some new development, but then there are those 12 units, built in the 50s and 60s kind of product. But it does provide a very eclectic feel. And so if somebody goes in there and really does a facelift on that stuff, you're close to everything. Millennials love it. Recent college grads, you're not in uptown per se, but you're a short drive from there. Rents are going to be a little lower, but I would say that it's very woodsy. It's got some hills and undulation to the land. So it takes you out of it, but you're still where all the action is.
Any other areas besides the Bishop Arts area?
Southwest Fort Worth.
Why is that?
A tollway was recently built that connects Southwest Fort Worth to downtown. 10 years ago, 5 years ago even, it probably took 25 minutes to get from a Benbrook type location to downtown Fort Worth. Now it takes 8. I speed a little bit, so if you're going the speed limit, probably 10. But it's connected downtown Fort Worth to that part of Southwest Fort Worth, and there's a 90,000 square foot Neiman Marcus going in, basically at the intersection of the Chisholm Trail Parkway and Interstate 20, and we're seeing some really strong apartment fundamentals in that pocket.
Chris, anything in secondary or tertiary markets that you like?
Well, a lot of these towns like Waco, Wichita Falls, I mean, you're seeing they're 100,000 population, even like Lubbock or Amarillo. I mean, you're seeing some really nice growth there. I think a lot of retail, restaurants, things like that, they've all of a sudden discovered those markets. So all of a sudden that you're seeing more of the main, anywhere from Olive Garden to Champs to, nice fast casual kind of restaurants are coming into those markets now. So those would be attractive too. I mean, the cap rates are a little higher and your competition's not going to be as strong, but still it's not a declining town by no means. Those are growing, populated areas, usually with some education, whether it be Texas Tech or Baylor or some sort of institution in those areas that drive it.
Yeah, Danny's been in the business for a long period of time. Chris, you've been in a long period of time. In fact, you've been in it since you were born. So tell me, how many people in the family actually are in commercial real estate in your family?
All of them.
Let's give a plug out to the rest of your family. Tell us their names and what they do in commercial real estate.
So my father, George Deuillett, went into the business in 1972 when they just opened up DFW Airport. And so 635, there was no 635 that went west of I-35. And so he was a land guy. So he sold all that land there, and nobody had any interest whatsoever of buying land out near this new airport. So then he retired in 98 doing apartments, and he worked for a couple of firms and enjoyed it. And his claim to fame was, if you drive on Hillcrest Road north in North Dallas and you drive north of Beltline, that turned into a dirt road. And so you can see how Dallas-Fort Worth has grown over those years. And then I have an older brother, George, works for another brokerage shop in Austin. And my younger brother, he has his own real estate company, does retail, leasing, and sales here in the Metroplex. And that's it. Yeah, so
if investors or anyone with questions want to reach out to you guys, what's the best way for them to contact you guys?
So contact Chris. My phone number is 214-979-6538. Yeah, feel free to call me with any additional questions.
Say phone or email is fine. 214-979-6586 or danny.baker@cbre.com.
So Chris mostly does the B and C properties in Texas, focusing mostly on the DFW area. Danny does the state of Texas, mostly institutional A-, some B+ type of stuff, typically transactions that are $10, $15 million. and above. So just kind of know where those markets are at. So I can't thank you guys enough for coming into the Old Capital Podcast. We appreciate Danny Baker from CBRE, Chris Deuillett from CBRE, Michael Becker, always a pleasure. Thank you.
Thanks, Paul.
James Heng, we appreciate it. Again, make sure you, on our reviews on the Old Capital Podcast, 5 stars. That helps us to get the good quality guests just like Danny and Chris into the podcast. Don't forget about Dr. Dotzer at the Grapevine Convention Center on April the 26th. So we appreciate you guys coming in. I'm Paul Peebles. Have a good day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.